Hi, welcome to this podcast where I'm going to be looking at mergers and acquisitions, and particularly the realisation accounts and sundry shareholder accounts that we do either in the company that's being acquired, in the case of an acquisition, or we do it in both companies' accounts if there was a merger, because effectively those two companies cease to exist and become the new company. So it's a way of closing down all the accounting records for a company which is going to cease trading. There's two ways that we do it. Normally we do it without a revaluation of assets, but occasionally we do it with the revaluation. We'll talk about with revaluation in a bit more detail in a moment. But firstly, we've got a company here that's got assets, equity, and some liabilities. And it's got a purchase price of £1,050,000. It's got the non-current assets are going to be valued at £1,050,000, and it's got goodwill for part of the acquisition process, which is being valued as £100,000. Now, unlike calculating the purchase price, the normal way or the most common way of doing this, we use the existing values in the statement of financial position for doing the realisation accounts and the sundry shareholder accounts. The realisation account, we transfer and close down all the other asset and liability accounts and transfer the values into the realisation account. So to close down the asset accounts, we need to put a credit entry equal to the existing debit balance, and then put debit balances into the realisation account. So for example, with the current assets, I've credited the current asset account for 50,000, so that we've no longer got the current asset, and it appears now in the realisation account. And just note, unless you are told specifically to revalue the non-current assets first, I'm using the statement of financial position for the non-current assets. For the liability accounts, it works the opposite way around. Because we have a credit balance on the current liabilities, I need to put a debit balance on there to close it down, and I need to credit the realisation account. And then this bit, we'll talk about it again in a moment, but the sundry shareholders account and the realisation account will take the purchase consideration. And I've used purchase consideration there. It's a posh word for price. That's because the consideration may have been in the form of shares or in the form of money. And we always debit the sundry shareholder account, the purchase consideration, and we credit the realisation account. So what's the realisation account going to look like? Well, we've got the two assets on the debit side and the liability, and we've also got the purchase consideration. And this account should balance at 1,150,000. And to make it balance, we need to put the profit or loss on the realisation in. So here, we need to make the debit side bigger. So there's a profit on realisation. And that's not surprising because we've got goodwill of 100,000 and the purchasers agreed that the non-current assets should have been valued at 1,050,000 as opposed to the 1 million in the statement of financial position. So that's where the 150,000 profit comes from. And when we look in a moment at the sundry shareholder account, when we balance the sundry shareholder account out, we should have the same 150,000 profit, but have a think before we get there about which side of the sundry shareholder account you would expect to see it. Okay, sundry shareholder account, again, I've done the journal entries just to make it a visual representation, but basically because all of the owner equity accounts are credit entries, an outside chance you could have a debit entry on retained earnings, so you need to think about that in an exam. But I am going to debit both of the reserve accounts, and then I am going to put them into something called the sundry shareholder account as credit entries. And again, I've done the same journal entry there just to show that it affects both accounts for the Sundry Shareholders and the realisation account for the purchase consideration. So what does the account look like? Well, you've got the two credit entries that we've put in for the equity that we've transferred. We've got the purchase consideration that we've spoken about. That goes on the opposite side because it's effectively saying that we've now paid back the shareholders, and we've paid back the shareholders 150,000 more than the value of their equity. Okay, so the reason why the purchase consideration goes on the debit side is because the business no longer owes the shareholders any equity. They've been repaid, and they've been paid with a profit of 150,000. And so that explains where we get this journal entry down here if you asked to do it in the exam. With a profit, we would debit the realisation account and credit the Sundry Shareholders account. And if it was a loss, we would debit the Sundry Shareholder account and credit the realisation account. Now, there is an argument that it is more realistic to revalue the assets particularly before we do the realisation account and the Sundry Shareholder account. Occasionally they ask you to do this in an exam question for the board that I teach. The logic behind that is some of this profit that they made, the 150,000 on the previous slide, is actually to do with the fact that the assets were worth more than the price that was in the existing statement of financial position. And that's not really a profit to do with the fact that you sold the business. That's a profit to do with the fact that, for example, the buildings or the land have appreciated in value. And the argument for doing the revaluation is it makes it clearer to the shareholders what part of the profit is to do with the fact that their assets have been undervalued and what part of the profit is to do with the fact that somebody's agreed to buy this business for more than the actual asset value. The argument against it is really it doesn't really prove an awful lot, particularly if your shareholders are involved in the management of the business. If it's a private limited company and everybody's involved in the management, they will know anyway that it's been agreed that the land and buildings, for example, were worth more than they showed in the statement of financial position. So if we're going to do that, then we would have a adjusted statement of financial position. Okay, and we need to create a revaluation reserve. And the change in the realisation account is that the value of the non-current assets will be higher, and the amount of profit on the realisation will now only be equal to the goodwill element. And similarly, on the Sundry Shareholder account, we would have the revaluation reserve showing in the Sundry Shareholder account, but we would have the new lower profit on realisation because the shareholders, once we did the revaluation, were owed that extra 50,000. Done a question for my students to have a go at. Do it without and with the revaluation. And then for my students, there is some other work that I've put on your Google Classroom. Okay, thank you very much for your time. Any questions, email me. It's relatively straightforward.